Hello, 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 hello. What's going on, everybody? Welcome now, Stock Trades. How's everybody doing today? All right, ladies and gentlemen, in this video, we're going to go ahead and do a comprehensive analysis on what happened with the earnings for Clover Health. And first, I want to point out that this is for educational use only. We're going to have academic and theoretical exercise. I think this is a wonderful than using a textbook because we're having a lot of a fear in the market right now. And definitely, we're going to go ahead and also talk about Alignment Healthcare because Wall Street always cares about free cash flow. And Alignment just said the magic word in their transcript saying that they're going to be free cash flow positive this year. And Clover said the same in terms of cash flow from operations being strong. We got to go ahead and mention that. But remember, this is for educational use only. This does not constitute financial advice. Now, with that said, I went ahead and I did some research. In this video, I'm not going to be doing education, right? This is not going to be an educational video. I mean, you will learn something, but this is not going to be explained from an educational content. Like I'm not. It's going to be educational, but I'm not going to be spending a lot of time teaching, if that makes sense. I'm gonna show you what I found. And I'm going to explain to you kind of what I think, but I'm not going to go over a sentence and break it down like how I do from first principles because there's just so much to go through. And, but we are going to educate, but it's not going to be like the crazy education that I go when I whip out the iPad, etc. Okay. Now, TLDR, based off of what I'm seeing, I'm incredibly bullish about what's happening right now. And I know that's crazy. Especially what's happened. There's a lot of people selling right now, and it's really great to show you kind of the psychology of the market. So it's retail investors are going to be retail investors. We obviously, I think personally, there needs to, I think there needs to be some selling from retail, and that's what Wall Street wants. In fact, there was a Benzinga article published, and then there was a correction. For some reason, but the Benzinga article stated that Clover revised guidance downwards in terms of revenue. And then they ended up correcting it at 1 a.m. You guys can find that data. So it's like, who's awake at 1 a.m., right? So they ended up correcting it at 1 a.m. Also what I found, and this is actually even in our AI, our premium Al stock trades terminal, there is a confusion between part D and part B. So what they did is, and it's funny because they did it both for Andrew and they also did it for Peter when they talk about part D. And I'm going to explain to you guys that. So part D has been the culprit, but it's funny how like when they're talking, the transcript stated part B remains a big known unknown for the second half of the year. And then watch this. This is consistent with the recently published Part D direct subsidy rate. And it's funny how they correct it, but they put Part B. So go ahead and check your transcripts data. Go ahead and check whatever transcripts you can check, and you'll see the transcripts say Part B. That is incorrect. It's actually Part D. So what I'm seeing right now is I'm seeing a lot of games being played. What looks to me like an actual really good earnings report. And I'm going to explain to you why I think that, because at the end of the day, all I care about is if the counterpart assistant is working, and it is, right? So we're going to go, I'm going to drink some coffee. Mm-hmm. Yeah. And so let me go ahead and see what, because there's a lot of things we need to talk about. There's so many. I don't know if I should talk about this first or I should talk about this. I'm going to go ahead and actually talk about this first, and then I'm going to go ahead and talk about this. And then I'm going to talk about the numbers. And I think that would be great. Secondly, Peter went ahead and let me just kind of show you guys. Let me log on to LinkedIn here. Hold on. So let's go to Peter. And he posted this today. Again, there's a lot of, I bet you there's going to be a lot of retail investors saying, thank you for the 20% stock price drop and all this other stuff. And again, this is just retail. Let me see here. The big thing here is look at this guy. This guy said, great results. And it's funny, I have some connections with him. Curious to see who I have connections. Interesting. Cybersecurity. Maybe for the medical side of things. Interesting. But I'm going to go ahead and like his comment. It's interesting because UBS downgraded Clover Health today from like $4 or $4.50 down to $3. And it's funny because they say great results. And this is quite interesting. I believe there is a coordinated effort to depreciate the stock price so that institutions can buy more. On August 4th, what we're going to end up doing is we're going to end up seeing more institutions pile on for Clover Health. And let's see here. Yeah. So we're going to go ahead and see more institutions pile on and a lot of the SEC 13F documents filing in. We're going to go ahead and study those. So we're going to be talking about this. But the one I wanted to mention is, why is a UBS person saying great results with the senior vice president, and then all of a sudden they downgrade the stock? Again, guys, retail investors have some very valuable shares, in my opinion, again, from an educational perspective, but this is what I believe. And I think in the next 2 years, we're going to go ahead and see that. So I'm trying to figure out kind of what to talk about first. There is a lot to discuss. So we're going to go ahead and start with this one. So I went ahead and I went through every earnings transcript. And I looked at Humana's earnings transcript, Alignment's earnings transcript, Clover's earnings transcript, which you're going to end up seeing here, and also United Healthcare's earnings transcript. And what I did is I went ahead and I looked at Part D. So I wanted to figure out kind of what's going on with Part D. Part D is for the prescriptions. So this is Humana. This is from the Humana's earnings transcript from, I believe, Q2. They state, from what we are seeing in the direct subsidy, the industry Part D appears to be more consistent next year and within the range of our expectations to slightly better. This is George. He's the president of insurance segment of Humana. So what they're basically saying is they understand that the Part D is a little elevated this year. Why? Because it's new. It's part of the Inflation Reduction Act. It's part of, our IRA. They named it in the earnings report for Clover. I think if you control, maybe I pulled it here. Part D IRA. A lot of folks probably didn't know what this means. It's Inflation Reduction Act. So this is a new platform in which they have, which obviously there's no historical data. And what they're basically seeing is this direct subsidies for next year is going to be offset to even be part of expectations or slightly better. So the headwinds that we are seeing today could ultimately get fixed next year. And if not, at least be at expectations. And they start, so Clover's quarter end, they start the quarter on January, right? You got January, February, March. The end of March marks the end of Q1. They don't report until May 5th, approximately. So what ended up happening is on July 9th, Clover announced a partnership with the New Jersey Community Pharmacy Program in partnership with IPC's iCare Plus network. I was trying to figure out why they did this because it's kind of interesting and, it makes sense. You want to track prescription refills. You want to identify gaps in medication adherence. You want a collaboration closely with local doctors. But also what's interesting is Part D is part of pharmacy. And then what do? Now they're attacking the pharmacy programs, trying to look at the data, trying to, because again, these pharmacies, they work with Humana, they work with Alignment. They no, well, Alignment's not there, but they work with other healthcare insurance providers in New Jersey. And what they're going to do is they're going to take that machine learning substack and take all that data that the pharmacists give, and they're going to try to figure out, what is a good modeling system for Part D. So I was trying to figure out kind of what this was about. And then we go ahead and see the Part D bombshell that basically happened in Q2. Here's Alignment. The guidance raises, these are like splurges from Alignment. So it says here, the guidance raise, I pulled all of this from my my earnings transcript terminal, part of the Al Stock Trades platform. So it was very, very quick. I was able to go through it. So the guidance raises reflect strong fundamental performance across the business, an unchanged Part D outlook, and upside from sweep payments. So pretty much they're saying that they have accounted for these costs earlier on, pretty much, right? No, here's the other thing. Additionally, our Part D MBR, it's like this, kind of the same thing as like MCR, right? Was slightly favorable in the first half, right? While 6 months of experience, we now have further confidence in our full year expectation for Part D. This is James Head he's the Chief Financial Officer at Alignment. And then they go in even deeper. They said that second, while our first half Part D gross margins ran a few $1 million favorably to our expectations, we are keeping our full year assumptions approximately unchanged because they're scared that Part D may actually be worse. Based on the first 6 months of our Part D, as in dog, experience, we feel confident that our outlook assumptions accurately reflect underlying cost trends in Part B and continue to expect our Part D MBR will be modestly lower in the second half compared to the first half. So that's interesting. Okay. Additionally, we continue to expect changes in Part D seasonality due to here it is, due to the Inflation Reduction Act, including a higher MBR, which is like like a medical cost ratio, right? In the fourth quarter relative to prior years. So this is where it gets dangerous. Okay. So Alignment is pretty much basically saying, when I say dangerous in the short term, okay, Alignment Healthcare is saying that the fourth quarter, they're going to basically see a lot more MBR, which is their like medical cost medical cost ratio version. So the question is Clover going to be seeing the same thing? Now, if you go ahead and go to our stock terminal, and if we go to the earnings transcript, and if we go to Clove, and forget the second quarter, if we go to the first quarter, and if we go to Part D, and if we zoom in, Andrew Toy talked about Part D, but watch, look what he said. Our Part C and Part D utilization costs are both tracking as expected. We are also navigating the HCC V28 phase smoothly with Clover Assistant. Why is this important? Because it shows our technology care. So, again, unfortunately, it was not as expected, and their cost actually went up. Okay. So that's an uptick. But here's the problem. Okay. And this was where my problem was. How much of the uptick, and this is where honestly the iPad would do great, but how much of the uptick was actually their tech-enabled Medicare Advantage cohort, PPO, versus Part D? Okay. And I have a data in which I can show how the MCR normally tracks for new members. It probably won't be in the best interest to to try to find it in this video, but given that it would enhance the discussion, I think it would be good that I actually see if I can search for it. Yeah, there it is. I found it. Okay. There it is. Okay. So I'm going to go ahead and you guys can follow me on underscore Albert Allen and Al Stock Trades. I post some really good stuff, very good educational content. So check this out. This is from an older slide that they had, and this segregates new members versus returning members. And you can see the medical care ratio or medical cost ratio, I like to call it medical cost ratio, of a new member is anywhere between 95% to 105%. I'm going to say this again, and I'm going to say it 3 times. New members have a medical cost ratio of 95% to 105%. Okay. Returning members end up basically having a drop of 70 to 85%, which is pretty much up to a 35 basis point drop. They advertise a 1,500 basis point drop. So you can see there's actually a lot more alpha and a lot more room to drop. So I'm going to say this again. New members have a medical cost ratio of 95% to 105%. So what ends up happening is these new members that they got artificially increase the costs. But how much of that cost increase was the new members and how much of it was Part D? We can actually calculate that. And I'm going to show how I do it based off of what they were prescribing in their earnings report. So very quickly, if we go to the earnings report here and we open up the supplements too, and if we go here, actually, this is a better visualization in my opinion. One moment here. Just a little bit here. I'm trying to find where they talked about. Oh, there it is. I was looking for this. Okay. So what they did is their BER changed from 87% low end to 88.5. That's a 1.5% increase. Okay. And their 88% upper bound went to 89.5%. Okay. So 88% to 89.5%, that's a 1.5% increase. So essentially what they did is from the lower end and upper end, they increased the BER by 1.5%. And we know there's a 6.1 differential based off of last year's data from the MCR. So based off of this, MCR ticked up by 1.5% theoretically here. And that has to deal with Part D. Okay, Part D, right? So the question now is, okay, well, if Part D is going up, does this make this whole business unsustainable? Absolutely I not, right? And that's what was my initial worry, right? And this is what I was looking at, and I'm going to basically showcase, because if you look at it, the adjusted SG&A actually went down. So what they did is they dropped the SG&A by 1%, trying to offset this increase in BER. Okay. So it's very clear that management is very good in this. And what I found interesting is that for the adjusted EBITDA, they kept it the same, which means that in the backdrop in Clover's dark rooms where they talk about the business, I think they potentially anticipated Part D may become an aberration, in which the adjusted EBITDA actually stayed the same. They like, because I was wondering, I'm like, they're going to have to increase guidance because it doesn't make sense. Because if you go back to quarter number 1 for the supplemental slides, they were, this was their guidance. If I can find it. Their guidance was, the same, right? They increased it on the bottom end by $5 million, right? 50 million to 70 million for both adjusted EBITDA and adjusted net income, right? And what's interesting is, I was like, well, they're going to have to increase guidance because of this slide right here. They're, it has to deal with this one right here, this slide right here. I was surprised because their adjusted net income increased by 322%. This does not have the Part D issue from the Inflation Reduction Act that the new administration created. So I was surprised to see this big jump, because that's like $25 million of adjusted net income and $26 million of adjusted EBITDA. So that's weird, because remember, they guided for 50 to 70 million. So that's almost like 25% of their lower end. No, I'm sorry. That's 50% of their lower end. So I'm like, they're going to have to, and they strategically say it here, significant increase year over year adjusted net income and adjusted EBITDA as a result of a strong MA performance, well-managed cohorts, differentiated ability to better manage the total cost of care via technology, and continued focus on SG&A optimization. Okay. Right? So I was surprised to see this huge increase, but then the second quarter came, and then I'm going to see if they look at adjusted, and then here's the adjusted EBITDA. So if you look at adjusted net income, and I'm curious to see, here's adjusted EBITDA, we got a decrease now from 36 million to 17 million. And I'm curious because I want to read right now what they say here now. Strong second quarter and year-to-date adjusted net income as a result of strong MA new membership growth and cohort management, partially offset by elevated utilization, further highlighting the strength of our tech-first care model. So what's interesting is, even that they increased their revenue, they are still year-to-date analysis with 79,000 members versus 103,000 members. They still have the same adjusted net income. Okay. Now, again, I think this is a little sugarcoating in my opinion, because it's using this first quarter data that did not have the Part D costs. So there's that. So you could take that as you may. However, they're pretty much saying that in the future, in the earnings call, that Part D may essentially be able to solve itself. But if they were worried about the outlook, then they would have decreased the adjusted EBITDA and adjusted net income. Now, of course, regardless, now they have because they said they have about $42 million now of adjusted net income and around 43 of EBITDA. They're guiding for around 50 to 70. So on the lower end, they only need to make about $7 million more of EBITDA in 2 quarters, or on the high end, it's $27 million more in essentially within those 2 quarters of third and fourth quarter to essentially be able to meet their guidance for adjusted net income and adjusted EBITDA. So what that means is I'm expecting the adjusted EBITDA and adjusted net income to be a lot lower in Q3 and Q4. And it's actually interesting. We should look at it. So if we look at the supplemental slides, adjusted EBITDA was 19 million. So right now they're at 42 million. If you add 19 million, you'll be at 61. I don't think it's going to be 19 million. I think it's going to be a lot lower. And if you look at the fourth quarter here, the supplemental slides for here, I'm trying to find the slide where it talks about adjusted EBITDA. So, okay, there it is. So, all right. So fourth quarter is 8. So we might either stay the same for EBITDA for Q3 and Q4. So let's take a look. So 8. This will be interesting to see. So 8 plus 19 plus 42. That's about 69. So I don't know if they're going to end up getting lower than the 70 million EBITDA that they had last year, because they had 70 billion of EBITDA. And the way they're advertising it, they're saying that it's the same. So if that's the case, then the EBITDA, adjusted EBITDA, should be the same for Q3 and Q4, which then begs to differ the question, what is ultimately going to be the net income, the bottom line? Because as of right now, and this is kind of what I'm worried about, is if costs are going up, then ultimately what is going to be the overall net income for this year? And I think it's going to be, Q1 saved them about an 18 million because they only got negative 1.27 million. So I don't know what their net income is going to be for negative 9 and for Q3 and Q4 from negative 9 million, negative 22 million. I think it's going to be a lot worse, and that's me being bearish in the short term because of Part D. But you never know. Part D may end up, utilizations may not, like it may end up not being as bad in Q3. But if you look at alignment, which is what we talked about here, alignment, they're saying Q4 is going to be higher. So I assume that the net income this year is going to be either the same as last year, which is negative 43 million, right? Given that we had technically a pretty good break even almost quarter in Q1 2025. Or it could be a lot worse at a negative 60, anywhere between negative 60 to negative 70 million. So let's go ahead and let's look at Alignment Healthcare, and let's continue this because I haven't even gotten to the good part. I haven't even gotten to why I'm bullish, right? I'm just basically, kind of showing you kind of the thought process on how I basically went through this adventure called DD, right? All right. So this is another quote from Alignment Healthcare from their Q2 earnings that they had last week. So, but we see it across inpatient, outpatient. I think the notable difference is really in Part D, which we talked about on the call, which has a higher trend than the medical side of things. I'm going to say this again. Okay. I'm going to say this again. Yes, I agree with you, Heffler. They did buy back their treasury stock again. That's incredibly bullish. We're going to talk about that. Absolutely. And unfortunately, retail investors sold, but hey, you know what? I think it's time to separate the wolf, the men from the boys, right? And this is let nature takes, you're seeing a lion, institutional investors chase the prey, let them take it, let them eat it, let them, people, unfortunately, being rich is hard. If it was easy, everyone would do it. And it's, it is what it is, right? So with that, I'm going to repeat this again. Okay. So I think here it is. I think the notable difference is really in Part D, which we talked about on the call, which has a higher trend than the medical side of things. Okay. So I'm going to repeat this again. This is from alignment. Part D has a higher trend than the medical side of things. Part D has a higher trend than the medical side of things. I'm going to say it again. Part D has a higher trend than the medical side of things. One more time. Part D has a higher trend than the medical side of things. What does counterpart do? The medical side of things. It doesn't do pharmacy until they went ahead and posted this, which is interesting. Okay. And very quickly, I'm going to jump to the bullish part, one of the bullish parts. And I'm going to go through here and I'm going to read this. Peter said in the earnings call yesterday, I'll answer that question. So the cohorts want to make sure that the message is clear and it lands. The cohorts in our unique model, tech first model, are performing as expected in line. So their medical model is performing as expected. Clover Health's medical model is performing as expected. Clover Health's medical model is performing as expected. Okay? So for part D and supplemental, this video I'm going to focus on part D. Forget supplemental right now. I'm going to talk about that in an upcoming video. We don't see a specific split or between new and returning members. So returning members are definitely improving from an MCER, BR perspective, right? So what he's basically saying is part D is shit. Part D is dog shit right now, okay? Because it's new from the Inflation Reduction Act. Andrew jumps in and he says, and I would also like to add that, as we said in our previous commentary, as we model out parts, especially the part D, right, side of things, right, D for dog shit, right, which was in my section. This is the first year this is the first year from the Inflation Reduction Act that part D is there. We are still figuring out what the baseline models look like. The direct subsidy will increase going to 2026. I'm going to bold this. The direct subsidy will increase going into 2026. Andrew Toy said this. Does this make sense? Does this remind you of something? Humana's earnings report Q2. From what we are seeing in the direct subsidy, the industry part D appears to be more consistent next year and within range of our expectations to slightly better. I'm going to go back to what Andrew said. The direct subsidy will increase going to 2026, right? The direct subsidy will increase going to 26. I'm going to repeat it again. Andrew said yesterday, the direct subsidy will increase going to 26. And then here, Humana, different earnings call, right? Q2 said from what we are seeing in the direct subsidy here. Andrew said direct subsidy to direct subsidy for folks that have problems in understanding. The industry part D appears to be more consistent next year within the range of our expectations or slightly better. Next year is 2026 because this year is 2025, right? Maybe, I don't know. People on here maybe are A&O times one, okay? This year is 2025. Andrew Toy said the direct subsidy will increase going to 2026. So as Peter mentioned, like I think there's a reason to believe that any pressure we see, they will be appropriately priced in industry-wide going into next year as well. And we are also making sure that we keep an eye on the supplemental benefits throughout the year. So they are looking at this now laser focused because this throws off their whole thing. Everyone's looking at this and they're digging deep. And as soon as they see an uptick, they're going to say, what the hell's going on? Let's figure it out. Again, this is a management team that doesn't like to F around. Okay? All right. Because if it's true, think about it. If it's true that this is a shit management team, then they would have increased guidance in Q1, and then they would have ended up lowering guidance in Q2. But I was surprised they kept guidance the same when they got $25 million of adjusted EBITDA And I'm like, dude, that's like half of your guidance. When are you going to increase it? And they didn't increase it because they're smart, because they knew that Part D for dog shit was going to come and bite them in the ass, and they wanted to wait. And that's what happened in Q2. But it's okay because it's an industry-wide thing. Yesterday, I thought that this was affecting their medical side of things. And I got a screenshot from a transcript that was basically stating that maybe it was their Medicare side. That is bullshit. That is wrong. And I tagged Dish for that. I think that transcript is wrong. Okay. Or how I interpreted it was not correct. Because again, if you go back to what Peter said, and he said, let me make sure this message is clear and it lands. The cohorts in our unique model, tech first model, are performing as expected. In line with what? What is it in line with? What is it in line with? It is in line with this graph, this table. New members have a high medical cost ratio, 95 to 105%. New members are unprofitable. New members cost an uptick. They cost an uptick in the medical cost ratio. Returning members decrease in medical costs. You understand what I'm saying? New members, high cost. Returning members, lower costs. And what he's saying is that it is performing as expected and in line. So Part D and supplemental are aberration noise from the Inflation Reduction Act, which is clear that they're looking deeper into it. And they made a collaboration with the New Jersey Community Pharmacy Program in partnership with the IPC's Eye Care Network. So let retail investors become prey of the lions and let nature take its course, because the top 1% needs the bottom 50% in order to survive. We need the bottom 50% to keep rowing the boat. We need them to row the boat. Let them row the boat and get out, because that's the name of the game. We need workers in our beautiful economy. Not everyone can be investors, and it is what it is, right? And welcome to Wall Street, okay? So with that connection, I want to go ahead very quickly before I go to the other sections here. I'm going to go ahead and I'm going to go back and just kind of reset the page so it's clean. And I'm going to go back to quarter one, and I'm going to look at this. I'm going to look at quarter two, which is, I'm going to put them in order. I'm going to look at quarter three, and I'm going to look at quarter four. Okay. All right. I don't care about non-insurance. This was back in the day when they had ACO. I care about the insurance MCR, which is what we have now. I'm going to just kind of zoom it in so we can compare. Okay. This is 2022's earnings report. Again, guys, not a lot of retail investors are going through this because, again, these people need to row the boat. We need these, unfortunately, institutions need to come back online. Okay. It is what it is. And this is what's happening right now. And it's unfortunate to see. I made over 850 videos for education, and it is what it is, right? At some point, nature has to take its course. All right. Now, this is Q1 2022 in comparison to Q1 2021. Look at the insurance MCR. Wait, let me make sure. Yeah, it's annoying. It's highlighting the bottom here. I don't want it to highlight the bottom. Let me just, you can read it here. It's fine. I'm just going to highlight this. All right. So look at the insurance MCR. It went from 107.9% to 96.4%. What kind of over a year? What kind of drop is that? That's an 11.5% drop. That's an 1100 basis point drop. Okay. Now let's look at Q2. Q2 went from 111% to 92%. This is for Q2 2022 in comparison to Q2 2021. Let me remove the comments so we can see. 111 minus 92.1. That's an 18.9% reduction. That's a 1,800 basis point, almost a 1,900 basis point reduction. From what? From a year. Let's go ahead and look at Q3. Q3 2022 in comparison to Q3 2021. Let's look at the insurance here. We went from 102.5% down to 86.3%. Ladies and gentlemen, 102.5 subtracted from 86.3. That is a 16.2% drop in the MCR. That is a 1,600 basis point drop. Let's go ahead and take a look at the insurance MCR for Q4 2022 in comparison to Q4 2021. It went from 102.8% down to 92.4%. That is 102.8 subtracted from 92.4. That is a 10.4% drop. That is an over 1,100. That is over a 1,000 basis point drop. So now we looked at 2022, which clearly shows a drop in full year MCR of 106 down to 91.98%. The full year dropped average-wise 91.8. That is a 14.2% drop, which is a 1,400 basis point drop. Are you seeing the pattern? So now let's go ahead and now let's go to let's look at 2023. So I'm going to remove all this, right? And now let's look again. I'm not going to show this again, right? I'm going to now go to 2023 and compare it to 2022. Did they continue to improve their insurance MCR? Let's go ahead and do this. So I'm going to actually go from up here because the way it loads is it kind of loads it. Yeah, let's do this like this. So it's organized effectively. Okay, good. So we're going to go up here. We're going to go here. It's like watching an episode again, watching Buffy the Vampire Slayer again. You know what's going to happen, but it's good to watch it over again to see. All right. And by the way, these are not my words. Kevin didn't mention Buffy the Vampire Slayer, but Kevin, the VP of product design, said that let me go ahead and share with you what Kevin said. Again, not all people can become investors, right? We need people to row the boat. Let retail investors get eaten by Wall Street. Let nature take its path, just like watching a beautiful nature channel as the lion gets the gazelle. Let it happen. Let them rot. It's okay. Welcome to Wall Street. Either you're going to be a winner or you're going to be a loser. Okay. That's what life is all about. The people that do the hard work and the people that don't. Okay. Now, let's go back to what Kevin was saying. If I can find it. One moment here. Kevin said, this is from Kevin Hulb, the VP of product at Counterpart Health. We're uniquely positioned at Counterpart that I can go back and show longitudinally, actuarially, and actual publicly available results from our product. If someone wants to know how well we're doing as a product, I can literally point to our SEC filings of Clover going from above 100% MCR to less than 80% MCR. That is what we're doing right now. We are following in Kevin's guidelines into looking at the SEC documents, and that's what we're looking at. So let's look at now, we did 2022, now let's look at 2023. The insurance MCR now for 2023 in comparison to 2022. Remember, back in 2021, it was over 100%. So guess what it did? So now, after a year, the insurance MCR went from Q1 2022 to 96.4% to 86.6%. That is a reduction of 96.4 subtracted from 86.6. That is a reduction in 9.8%, which is 980 basis points. If we go ahead now and go to second quarter results in comparison to Q2 2022, we went from 92.1% to 77.2%. 92.1% subtracted from 77.2. That is a reduction in 14.9%. That is a reduction of over 1,400 basis points. close to 1,500 basis points. Ladies and gentlemen, you can read it here. Insurance MCR improved by more than 1,400 basis points. The data is in the pudding. Okay, it is in there. All right. Now let's go ahead and go to Q3 for the insurance MCR. They went from 86.3% to 78.5%. Why do you think I was banging the table in 2023? Right? So 86.3 subtracted from 78.5. That is a 7.8% reduction in MCR, which is equivalent to 780 basis point reduction. Now let's go to Q4, insurance MCR. The insurance MCR went from 92.4% in Q4 2022 to 82.4%. That is a reduction of 92.4 subtracted from 82.4. That is a reduction of 10%, which is 1,000 basis point reduction in MCR. You look at the full year, they went from an average 91.8% to an average full year of 2023 to 81.2%. That is a reduction of 91.8 subtracted from 81.2. That is a reduction of 10.6%, which is over 1,000 basis point MCR. Now let's go ahead and take a look at Q4 data. Let me go ahead and delete all this. Now let's look at 2024 for all this other stuff, right? So let's load all this other stuff here. Now we're going to compare 2024 to 2023. We're just going to organize it now to make sure it's good. All right. So now, if we go ahead and look at the insurance MCR, it went from Q1 2023 to 86.6% down to 77.9%. That is an 870 basis point reduction, which is equivalent to 8.7% decrease. They calculated for us. Thank you. That's another 870 basis point reduction. They literally went from over 1,000. They know it's, listen, guys. Okay. They know that they have had over a 3,000 basis point reduction. So there's another 870 basis points. Now let's look at Q2 in comparison to 2024 to 2023. Here's the insurance MCR. They went from 77.2%. You would think it can't go any lower, to 71.3%. This is Q2. That is a 590 basis point reduction. Now let's look at Q3, insurance MCR. They went from a 78.5% to a 78%, modest 50 basis point reduction, which is why I think that the costs this year are going to be a lot higher in Q3. I think we're going to see a higher MCR, and that's due in part with what they said, which is in line. As Peter said, let me make sure this lands into the thick skulls of people. The cohorts in our unique model, tech first model, are performing as expected and in line. The only problem is Part D and supplements. Part D for dog shit. That's the one that is new from the Inflation Reduction Act that Donald Trump made. Right? So now let's look at Q4. Q4 insurance MCR. It went from 82.4% down to 73.5%. That is another 890 basis point reduction, which is a 8.9% decrease. So for the full year 2024 in comparison to the full year in 2023, they went from 81.2% down to 75.1% reduction, which is a 610 basis point reduction for a 6.1% reduction. Ladies and gentlemen, this goes back to what they're saying in regards to the medical cost ratio reduction. That is the Clover Assistant. So what is happening right now? So in Q1, and again, now let's go to Q1 2025. Let's remove this. Q1 2025. Let's look at they don't report MCR anymore. You would have to calculate it. The MCR went from 77% down to a lower 77%. So the MCR stayed the same. What does that tell you? The MCR is being appropriately managed. The only changes is the Part D for supplements. Now, let's take another example right now in regards to the medical cost ratio trailing 3 years. Let me see here. There it is. I'm going to read this to you right now. I'm going to read this to you here so people can understand. MLR is medical loss ratio, okay? I'm going to repeat this. Medical loss ratio rebates are based on a 3-year average, meaning that rebates issued in 2024 will be calculated using insurers' financial data in 2021, 2022, and 2023. So what does that mean? They need to have, I believe, anywhere between 80 to 85%. I believe here it says 80%. I think it's 85%, right? So they need to spend around 80 to 85%. Maybe it was Biden. I'm not too sure. I rescind my Trump comment, regardless if it was Trump or Biden. My apologies. I blame the Biden economy, right, for everything. I'm just kidding. I don't know, guys. I have, when it comes to politics, I'm not the best, right? So I don't know who did I think it was Biden. So my apologies, right? Right. This is you know what, guys? I'm going to use Trump's word, right? This is Biden's economy. Okay. These are Biden's MCRs. Okay, guys, right? This is Biden's economy. These MCRs are Biden's MCRs. So it was Biden, right? My apologies, guys. Again, I will tell you what I know and what I don't know. And what I don't know a lot about politics. Right? I'm not really, I have a good understanding more than the general population, but I don't, I look at them as they're all shit, in my opinion, right? Because they're all garbage, right? So I don't like any of them, right? So I'm independent. I don't like Biden and I don't like Trump. Right? I'm gonna be honest with you guys. I hate all of them. I don't like any of these people. Okay. Right. So there's kind of my political stance there. Because at the end of the day, the rich always get richer and the poor are left to dry. Right. So in any case, going back to this, the medical loss ratio takes the 3-year average, right? So that means 2025 is ultimately going to be taking in 2022 3s and 4s. So we should technically calculate the average of those things. And we can do it honestly here. We don't have to look at all the documents. We can be smart about it. We can open up. First off, let me just kind of reload this because it comes clean because I had all these open. We could look at here's 2024s. Here's 2023s. Here's 2022s. So that's a 3-year. So let's look. So here's the full year. Oh boy. Here's the MCR for 2024. So this is again, guys. So I'm going to explain to you kind of why. Again, listen. I don't like that the MCR for Clover is 75%, but I also like it. It's a love-hate relationship because that's way below the average, which means that they're going to have to turn on growth, right? Why? So they can essentially be able to burn more of the medical claims because technically the members that come in the beginning, they lose money on them, which is good because it artificially increases the MCR, but ultimately it makes them profitable. Does that make sense? It's a flywheel business model and it's freaking working. And the only problem is the Part D crap, which they're taking initiatives on. Again, guys, short-term noise. Okay, now let's look at 2023's MCR. So this was 2024. Oh, they're so nice. They give us 2023's here. So that's great. So there's that. Now let's look at 2022's. 2022's MCR. That's what I'm talking about. Sexy, sexy, sexy. 91. Okay, good. Now let's take the average. 75.1 plus 81.2 plus 91.8. Oh, that I cannot type. Okay, so now let me make sure I got that right. You got me, guys? You got me, chat? I put that in right. Divide by 3. 82.7%. So someone help me. Is it 80? Again, I always forget this. Is it 80% or 85%? What is based off of this paper, the citation paper, let me make sure.
In individual and small group markets, insurers must spend at least 80% of their premium income, healthcare claims, and quality improvement efforts, leaving remaining 20% for administration, marketing expenses, and profit.
So in the MLR for higher large insurers, so again, if it's a small insurance, it's 80%. If it's large insurance, it's 85%. That's why I always mix them. So you sure it's 85%? You think Clover will be classified as a small group market or is considered a large group market? Well, if that's the case, then that's not good. Their MCR is a lot lower, which that's why they're returning to growth. It makes sense. It makes sense, guys. No, because we're about to eat shit if they didn't return to growth. Honestly, this Part D is honestly going to help us. It's just probably small, so it's 80%. So that's good. I mean that's good because if it's let's keep it both 80 or 85. Let's just whatever it is. That's probably something that we should ask in the earnings question. That's something that I need. Again, I don't know about this. Okay, so again, I don't like using ChatGPT because I think it's wrong, but it's not as accurate in my opinion when it comes to this type of stuff. But I can, I'll just drop it in the ChatGPT right now. I'm curious. We'll put it in here. So Clover Health is a regional Medicare Advantage plan. They're scattered across the nation, but based off of the data below, what are they classified as, and what is their 3-year average medical loss ratio should be? I'm curious based off of this. What do you think? Okay, so it looks like it thinks that it's going to fall under the 80%, which makes sense. We are above the average. So it makes sense why, because I think we could have gone another year. Okay, that's fine. Okay, so it's 80%. Okay, that's fine. So I think it's 80, right? Again, please correct me if I'm wrong. I'll tell you guys when I'm not confident in this answer, but I think it's 80. But again, I'm not confident, right? Okay, so with that, 2025, we're expecting, and this is why, and it's funny, this is why they stopped reporting MCR, because everyone's going to be scared. Their MCR is increasing. But they're talking about BER now, because then that's the investments that they use for quality improvements, aka also counterpart. They use that in there as well, their research and development. So I think the MCR, and we kind of did some form of preliminary calculation this year, but we could take the high average. Let me see. Let me go and find what I think MCR might be this year. Oh boy, let me find it. Man, I have heartburn, guys. I gotta get some heartburn here. Okay, let me see. I'm just looking at the projections for MCR. So what was the average that we calculated? It was 82.7.
82.7.
So 3-year average is 82.7. Okay. And this is from 2022 to 2024. So right now, green check mark emoji. I'm going to see if I can copy this green check mark emoji. Good. Right now, they are meeting requirements for being above that. Okay. So there it is. Let's take a look. That's a good response here. Medical loss ratio. What's the equation in comparison to medical cost ratio? Let's look at the equation. So it's quality improvements. It's more in gear with BER. You're absolutely correct. So that's actually interesting, guys. And I think maybe that's why they're transitioning. This is actually pretty good. It means that we're in line with this. But there's also something when it comes to medical costs. And I think it has to deal with something with that. And again, this is why they invest a lot in quality. So that's actually pretty good, guys. Okay, that's good. So good catch on that. So now from this, the average that I speculated for the projected MCR,
2025 projected MCR 82.16%.
I think it's going to be 82.16%. If we add the 6.1 differential, we get to 88.26, which is right in line with their what they were saying. It could be a higher one, but now watch this. So now for 2026, what CMS is going to be looking at for their payment year, they can't look at this no more. Nope. You can't do this anymore. They're going to have to do 2023, 2024, and 2025. So if we were to do that and find the average, now we take 80. So that we guess what? This drops to 91%. So now we don't have that drag anymore. So if we take 82.16 plus 75.1 plus 81.2, we divide that by 3. We get an average now. You see, this is the problem.
79.48.
We get an average now, 3-year average. Let me make sure.
82.7%, 2022, 2024.
This is to 2023 now to 2025. And their 3-year average now is
79.48.
79.48%. Let's say X emoji. Now, this does not meet the guidelines for CMS. Right? Exactly, right? So, and I agree with this statement. You are absolutely correct. So I'm projecting 82.16% for the full year. But that makes sense why they return to growth, because they want to artificially increase this MCR even higher. So, because ultimately these are going to end up being 75s, right? So that makes sense. So they can get their flywheel business model going. Okay. So that's that. Let me think here. So I want to make sure we are good. So we went ahead and we spoke about their MCR reduction, how it literally went from 1,000 basis points to, like pretty much dropped over 3,000 basis points. Or, sorry, up to 3,000 basis point drop. So there's that. So now that we talked about this, I'm going to just kind of remove all these things here so we can just kind of focus on some things here. Okay, so now let's go. So we talked about this. We talked about how the higher Part D, it has a higher trend than the medical side of things, and Clover likes the medical side of things. That's what they're selling for. And we already know that the Part D is going to be subsidized. There's going to be subsidies in next year. So there's that. Okay, what else? So the Inflation Reduction Act, and it's going to be the fourth quarter. Okay, so there's that. Okay, here's an analyst question. Okay, John Paul Stansel asked for Alignment Healthcare. He said, can you just, I think, talk about what was driving the Part D favorability in the first half? Because they were trying to figure out, like, why was Alignment so favorable? Because other insurers like Clover is not, right? So I think in the first quarter, you talked about non-well income subsidies being kind of a pressure point, but it would be great to hear kind of what's going on here. So let's listen, right? And and then it sounds like it flips in your expectations from the second half, and what's drives that kind of reversal of the favorability. So, why is the second half going to be a lot worse? And that's what Clover is saying as well. So he said, I think we're saying we want to make sure we've got enough cushion in the second half to deliver on the full year guidance, right? So they're trying to be protective. So we're sticking with our full year. A little bit of the favorability is getting moved into the back to provide cushion against the first against the things that we typically have talked about, which makes sense because the favorability for Clover was Q1 2025. They were almost at break even. Their EBITDA was literally, their adjusted EBITDA was around $26 million, 25 or was it? And that's pretty much basically half of their guidance. So that was pretty favorable. And it's kind of what Alignment was expecting, but Alignment's favorability was Q1 and Q2. Clover only had Q1, right? So again, here's the thing though, Alignment also has higher star ratings than Clover, from anywhere between 4 stars to 4.5 stars. So the fact that Clover is able to compete like this and still have a reputable upper version of EBITDA while making half of the revenue of Alignment makes it obviously a superior company. From a Wall Street standpoint, Alignment said something very critical. They said that they believe that they're going to be free cash flow positive from here on out. That is a signal to Wall Street that unfortunately is what Elon Musk said when they're getting to their triple dragon region. So that's a big thing. Now, did Peter say something like this? Yes, but he didn't say the free cash flow word. Even though they're a capital light business model, it's assumed. But we could go ahead and just do control find from our terminal here. Is this from Peter? This is Peter. Let me just read this really quickly. So the cash flow from operating activities was $5 million, favorably impacted by our results this quarter, bringing year-to-year cash flow used in operation to 11. We expect, here it is.
Next our cash out. Answers will remain strong for the remainder of 2025 fee, which will allow us to continue to operate from position.
Okay.
Strength as we invest in our growth model in 2025 and beyond. Finally, we have maintained a full year 2025 ad.
Let me think here.
Adjusted net income and adjusted EBITDA profitability guidance, underscoring our continued business execution, strong three-year membership growth, and the power of differentiated model care. And while our overall outlook remains consistent, we are providing the following guidance updates to reflect the latest developments in our boosted nest. We are increasing our Medicare Advantage membership guidance now to 104,000 and 108,000 members, reflecting.
Okay, so this is what they said during the second quarter. Cash flow from operating activities was $5 million. Favorably impacted by our results this quarter, bringing our year-to-date cash flow used in operating activities to $11 million. We expect that our cash balance will remain strong for the remaining of the year. So that's good. I think because they did cash flow from investing activities, they sold. But I want to know operating activities. Let's see anything in operating activities. Let's see.
This reflects our continued ability to gain operating leverage in our business as we grow. For the full year 2025.
Just make sure we don't. Okay, that's fine. Let's look at operations. Okay, let me just read this real quick.
We grow both membership and revenue by more than 30%. Year over year, and at the same time, we improved net loss from continuing operations by $54 million to $12 million and maintained our year-to-date adjusted EBITDA and adjusted net income steady at $43 million and $42 million respectively. Our results powered by our technology-first model care reinforce confidence in achieving our updated full year 2025 guidance. We believe this also positions us well for accelerated growth and meaning. This underscores the strength of our differentiated growth model, sound insurance over. Agents and solid cohort management. In addition, our performance this quarter resulted in insurance VR 68.4% compared to 75%. So
again, guys, it's tough to say here, but cash flow from operations, I don't know if he's saying that it's going to be positive this year, aka free cash flow. So it may lose its triple dragon effect, which is what you're seeing, or its double dragon effect, which is what you're seeing. But this is going to be temporary, given the Part D problem. But I think that based off of what I'm seeing, and I'm going to talk about the unpaid claims. We're going to talk about it with all of this here. So there's a lot to talk about. Okay, so there's that. Let's continue reading this. Which is, there are certain classes of drugs that have trended higher, right? So there's some drugs that have trended higher, which is why Clover started talking to pharmacists to get that data with their counterpart. And their utilization in a couple of non-low income populations where they got a smaller maximum out of pocket. And so utilization can bite you there. So I think it's just really just making sure we're being cautious. But again, our Part D margin is very, very consistent. That's different. And again, they talked about having hot pockets, right? That's different from others. It's consistent with our overall MBR. And so as we navigate this year, our first year with post, Inflation Reduction Act, I think we're feeling pretty good that we can deliver on the kind of overall forecast that we had. So the fact that now Counterpart is being used in other areas right now, it's obviously collecting that data, and they're going to get more Part D data to potentially be able to offset this even better in next year, including with the tailwind of the subsidies. Okay. Now, United Healthcare said, this is United Healthcare's earnings for Part D. Within the seasonal pacing compared to the historical measures is impacted somewhat by Part D coverage. So you see here, historical measures is impacted somewhat by Part D coverage gap modifications due to the Inflation Reduction Act, right? With the first half results at the midpoint, that places the second half as just under 91.5%, with the fourth quarter expected to be the highest, which is unfortunate for Clover because everyone's expecting Part D to be the highest, which sucks for us, but it is what it is. And at the distance in a relatively proportionate distribution on either side. This is John Rex, CFO of United. So I just showed you data from United, Alignment, and Humana, and of course Clover, that shows that Part D is for dog shit and it's causing problems. But luckily, they're saying that next year the subsidies will actually start to alleviate that. And the problem is this part of the medical model of Clover or the pharmacy? And it's the pharmacy. What Peter basically did is he tried to basically put the nail in the coffin, and he said that I'll answer the question. So someone asked him a question. I just kind of put his response here. He said, so the cohorts are going to want to make sure that this message lands clear, right? The cohorts in our unique model, tech first model, are performing as expected, in line to what? In line with what, guys, right? In line with the 95 to 105% increase, and in line with what Kevin was saying, how they can go from over 100 basis point reduction down to under 80. So it's performing in line of what basically Peter is saying, okay? Because what ends up happening is this is why earnings are important, because they give you more than what it's in the data. Because this is what got me worried, and this is where I'm going to talk about why I was bearish here, okay? So this is, what is this? This is Q4 2024 data. This is Q1 data. And this is Q2 data. This is the one that was what got me bearish. And I'm going to explain to you what got me bearish, because it's hard to figure out Part D from like the other parts, right? So watch. If you look at the insurance net claims incurred revenue, and if you look at insurance revenue, and if you compare it from like last quarter, like for example, last quarter, we can look at both. If you look at from like Q4 2023 to Q4 2024, the revenue increased by 9%, right? But if you look at the insurance claims, like the costs, it actually went down. You see how it went down? That's actually good. It means that the medical cost ratios are improving, as what you can see here. This is the proof that the medical cost ratios are improving. So I like to see that. That showed me that this business model is sustainable for low growth at 9.1%. Now, if you go ahead and take a look at here, they went the full year. They increased revenue by 8.8%, and their cost actually didn't go up. Their cost didn't even go up. So by increasing by 8.8%, their cost pretty much went up only by 0.7%, less than 1%. That's what I like to see. So that got me really excited. Then came Q1. Here's the insurance revenue for Q1. Okay. Insurance revenue grew by 33.7%, right? From 341.7 million to 456.9 million, right? And obviously you can look at total revenue here as well, right? It went up 33%. But here, and watch this. if you go ahead then and take a look at, let's see here, insurance net medical claims incurred, it shot up to 38.7%. Now, again, that's obviously not good. It's in line with basically the cost of the insurance. I would prefer the insurance revenue go up higher in terms of the percentage change, rather higher than the cost change. But you can see that even with this increase, they were still, from an insurance subtraction from 456 subtracted from 367, it shows that the business model works. It gives them a buffer. Obviously, these will eventually end up changing as they optimize for SG&A in the future. So that's fine. And it shows me that they can still maintain a buffer in the insurance revenue subtracted from medical claims, a buffer of around, $89 million. That's pretty good. And then next year, these newer members, the returning members, will ultimately become profitable members. So it's like a flywheel business model, right? But then something happened. Q2 happened. And then this is what I was looking at. And this is why I was very bearish, because I needed to look at kind of what's going on. And I get it. They said 4 stars. This is them being at 3 stars. Okay. So this is ultimately going to be a lot bigger, right? And the relative costs, the bonus payments are not going to be as much. There's going to be a 5% differential, but still, you had a 34% increase in revenue. But watch, look at the medical claims incurred. They went up 58%. So now you have a spike, a 34% increase versus, for every revenue increase, there's a spike of 58%. That is not good. That is not sustainable. That does not look like a business model. That looks like a failed business model in the long term, right? But looking at what they said here, it looks like their tech product, and this is why I was kind of iffy on the end. I was like, I don't know. And then someone said, Sandeep was saying that is actually just the Part D. If that's the case, and that's what he's basically saying here, then this is a temporary, short-term speed bump. Sorry, this one here, because you can't have 34% increase and 58% increase. It's just tough, because what ends up happening is it ruins your buffer. They surprisingly, they still have a 75 million buffer, but again, it should have been a lot better, right? In terms of the cost went up by a lot. Okay. Which is why EBITDA ended up going down, the adjusted EBITDA. Okay. And then obviously the BER went up higher than what they expected. From here. You can see only a slight increase, 86%. Now it's 88, right? That's why they increased their BER. So now this is for this quarter. Now, a couple things I want to talk about. So if you look at their cash reserves, people might think that their cash reserves went down. But when you look at cash, it's the only one that you want to look at from last quarter to this quarter, because you want to see what's going on with the cash. So to look at that, you would have to look at Q1 the reporting scheme of 2025, which was like 3 months ago. And you have to scroll down to cash and cash equivalents. And you can see the revenue, you can see the members have been growing. And they said that they're going to be growing, they're going to get more members than what they anticipated, right? So if we go down to cash and cash equivalents, you could see that, they actually had $155 million in cash. Their cash dropped a lot. And that was because they were buying back shares. Do you remember? So their cash went from $155 million to $188 million. So what is that difference in 155 to 188? So what's that difference? 188 minus 155. I'm not going to look at the other numbers. That's approximately a $33 million difference. So how do they increase cash by $33 million, but ultimately be unprofitable this quarter? That doesn't make sense, right? No, it actually does make sense. You just have to look at the document, right? So to answer this question, you would have to look at the cash flows of this quarter. By looking at the cash flows, there's something here called cash flows from investing activities. So cash flow provided from investing activities increased. The question is, how much did it increase by? So to answer that question, because this is 6-month end, it's not the quarter end, we would have to look at the cash flow statement from the Q1, just like we did for the cash and cash equivalents. By doing that, we go to the cash flow statement. And you look at the cash from investing activities was 8.9 million. Okay. So to answer the question, you take this number,
8,930.
subtracted from this number,
44,496.
and you get $35 million. And then the other $4 or $5 million. So you get $35 million. Okay. The problem is cash only went up to around $33 million. So the question is, what did they do with the other cash? Like what are they doing with their cash? Right. So to do that, we would have to look at treasury stock. This is treasury stock. They were now at 71 million. I know it's in parentheses. This is called a contra equity account. You don't know what that is? Go ahead and learn it. Okay. So to find out how much did they buy back in stock, so instead of basically taking the stock and selling it to the open market, they ended up buying it back. They ended up using hard-earned cash. Okay. So to answer this question, you would have to go to the balance sheet. And you could see here that, let me go ahead and they used to have, 18.7 million shares. Let me see here. 18,752 cost 28 point this. So you could see the shares went up 28 million from 25. So kind of what's going on? So to find the difference, you'd have to take this number here,
71,415.
subtracted from this number here.
62,947.
So you subtract these numbers, and you get a difference of 8.4 million. So they purchased another $8.4 million in their stock, right? And again, that's unfortunate because not a lot of retail. Again, people are. That's why this the senior vice president of UBS was saying great results, right? And then retail investors, because they're idiots. I mean, we have retail investors saying, "Oh, I'm selling, I'm done, I'm done." Man, again, you are free to do what you are free to do, but I would like to thank you, pat you on the back, and wish you good luck on your 9-to-5 journey. And thank you for contributing to our beautiful American dream, right? Thank you, right? Again, you are well needed. You are an asset to our economy. We need people like you. Buy high, sell low. You amazing. Again, we need people like you. Okay, right. So again, that's the whole that's the image from the educational perspective what Wall Street likes to look at people, right? So let's look at our tri-financial statement engine here. Let's open this up. Let's look up Clove right now, right? So look at the balance sheet. Assets. Let's look at quarterly. So assets slightly went down, and then liability slightly went down. So if you subtract it, 583.72 subtracted from 574.99. Assets went down by 8.7 million. And then liabilities went down by 16.89. So liabilities went down more than assets. That's exactly what you need to see. This is very good. Okay. Now let's go ahead and look at the cash flow statement here. And then let's go ahead and let's look at, give me a moment. Let me analyze. You can see stock-based compensation has been, going down. So that's good. It used to be a lot. So I'm hoping for stock-based comp to go down in the future, because that's if stock-based comp would have gone down, they would have been profitable, right? They're a profitable business model now. It's just what's causing them problems is the stock-based compensation. And that's only going to end up going down when they start making a profit. And then instead of basically giving out stock as compensation, they can give out cash from their profitable business. And we could calculate kind of when that might be, because it's curious. Because very quickly, if you look at Palantir, let me just kind of look at Palantir real quick. If you look at Palantir's stock-based comp, it's honestly still freaking high, but that was the one thing that the stock-based comp for Palantir, it was always the argument, but obviously it ended up helping Palantir. So you could see it went from 1.275.4, and I think now it's slowly going to start going down based off. Last year stock-based comp for Palantir was 691 million. Stock-based comp this year is laughable.
155.34,
It's around this much. It's around 315 million. It's about 630. So it's in line, but I think as they increase profitability, because Palantir's trying to attract the best and retain the best. So that's interesting. So there's that. Let me think. Going back to Clove now on the cash flow. Common stocks repurchased. Watch this. So this is what I want to talk about. This is why a lot of retail investors, unfortunately, Wall Street calls them dumb money. So Q2 last year, they bought 3.22 million. I just calculated that they bought 8 million, right? So you could see it here. And our Tri Financial Statements does it automatically. So Clover Health bought another 8.47 million in stock-based comp. Last year, they only bought 3.2 million. You could see they accelerated their stock-based buying, right? So Q1, they bought 31.96. Q2, they bought 8. So this is a huge increase. So I'm expecting for them to continue doing this, especially probably now, given that their stock is incredibly valuable. So what they're doing is, instead of selling it on the open market, they're buying it, and they're basically paying the taxes for those folks, and they're keeping the shares instead, because ultimately they think the shares will appreciate in the future, so they can sell them up higher, which will help with stock-based compensation, because it'll end up decreasing. So I think that's the game that they're playing. Okay. So as of right now, in terms of stock-based compensation, we can, let's say, take a look at it right now from the earnings report here. Let's we looked at the Tri Financial Statements, looking at Q2. So we talked about treasury stock, we talked about the cash reserves. Now let's go ahead and talk about just kind of a more abbreviated Q2 result here. I want to basically point this out. Okay. So if you look at right now, adjusted net income, you can see right now, technically, even Clover's disastrous increased Part D for dog shit, MCR, not in relation to the medical side of things, it still would have been profitable this year. It still would have had a profitable quarter. Now you might basically be shaking your head and be like, what are you saying? How are you saying that this is profitable? Well, look at stock-based compensation. Okay. They're adding this back in there. Assume, so this is $26 million that they are taking out that is affecting, this is, again, guys, stock-based compensation is affecting their bottom line. So if you look at the income statement, right? Right. Within here, salaries and benefits, within somewhere here lies stock-based comp, right? And what's happening here is they're removing I'm trying to give me there it is. They're removing it, and then they obviously have a calculation for EBITDA somewhere. I think it's the upper one here. EBITDA 17 million. Just for right now, I would rather do net income because that's good. This is adjusted net income. This is coming from their GAAP. If they add their non-recurring legal fees and their stock-based compensation, technically Clover would be at 16.7 million. So what does this ultimately mean? It means that as Clover Health gets in new members and they accelerate growth, they're going to have cash burn, right? In terms of being unprofitable. And what they're doing is they're counteracting this from the cash flow from investing, which is increasing their cash reserves, right? And these are probably all strategic investments that Scott did back in the day, right? But ultimately, after these new members become returning members, and based off of what Peter was saying, the business model is intact, it is essentially showing that over time, this here net income will ultimately be positive. And it's going to get to a point where this will be larger than this, to a point where, they will obviously, it's going to ultimately be profitable. But assume this, as the company gets more profitable, this number will be so large that they're not going to have to deal with stock-based compensation. So right now they're at 26 million. So at what point, honestly, at what point will they stop issuing stock and just give out cash? Again, I don't know when's a good moment for this. It's tough to say. I say it's better for them to give out stock because cash is king. Later on, again, this company has no debt, right? And then what they can do, honestly, is they can lower stock-based comp by $10 million. And then that will bring them profitable. That will bring them at break even. So there's that. Then if you look at Q1 adjusted net income.
Adjusted net income?
Again, I'm trying to go down here. Sorry, I went down too far. If you look at Q1 adjusted net income, they were at negative 1.2 million. If you added back that 16 million or just added back 10 million, you would still get around, 10 million of profit. But you'd see here, that's $25 million of adjusted net income. Now, adjusted net income is on par with, EBITDA in a sense. So if we were to just look at Clover now, they were still able to do this. They're guiding anywhere between 50 to 70 million of adjusted net income. You take the halfway point, that's 60. Now, if you look at Oscar, now obviously Oscar, they are, with what's going on with them, they're guiding to be negative because of Medicaid, which obviously Andrew Toy said that they're going to be insulated from this. But if you look at Oscar, their price to earnings now is no longer reported because they're unprofitable, right? But before it was around 35 to 45, right? Price to earnings. So given that we know this, we could take two calculations. We divide this by 509. we get 11 cents, right? Which is kind of what they were basically doing in regards to that 11 cents estimate. So if you do this here, let's just take this whole number.
0.11787819253.
And if we multiply it by 35, which is, you get a $4 stock price. And if we do 45, we do a $5.30 stock price. So again, Wall Street's smart. They know what's going on. There's a little uncertainty with Part D right now, right? But Clover is operating profitably right now. The only thing is it's stock-based compensation. And the only time they will actually be in the books profitable is when this becomes profitable on a GAAP net income basis. And that's going to happen once they get these newer members to becoming returning members so that they can become profitable. And that's just, you're going to have to wait for the cycle to be. So for me, what I'm doing now is again, I'm looking at the comments again. I'm sorry. I've been really bad with the comments right now. Because the reason why is cash is king. Andrew Toy, I think, again, from an educational perspective, because it's better to use this rather than a textbook. They want to, instead of using cash, use stock, because stock is technically free for them. Okay. If you argue this, go ahead and look at Palantir and see how successful it was for Palantir, right? Clove quietly operating profitably while acquiring their own stock at dirt cheap prices. They're, yeah. So from that perspective, they're acquiring more of their stock. They're technically profitable if you excuse stock-based compensation. And, but here's the thing though. So the question is, when are they going to be profitable? Okay. And to answer this question, you got to look at what Peter posted today. He said that they're going to be accelerated growth. So watch this. We believe we are well positioned to achieve our update full year 2025 guidance and accelerate growth in adjusted EBITDA profitability in 2026. So they believe that they are going to accelerate adjusted EBITDA profitability, which means it's going to be good. It's going to be better. But the problem is he didn't say they're going to be adjusting net income, right? Or not net income. He said that they're not going to be accelerating net income profitability. And what that basically means to me is that they most likely are not going to be profitable from a net income perspective next year. I don't think Clover is going to become profitable next year from a net income perspective, which is unfortunate. I think 2027 or 2028, they are going to be profitable for, I would say, consecutively quarter over quarter. Now, I'm not saying that they might not have one quarter of profitability. Who knows? Maybe Q1 of next year is going to be profitable. Again, I don't know, right? But they might have maybe a couple quarters of profitability, or maybe one in 2026. But I don't think it's going to end the full year of being profitable, right? But the fact that they're saying that they're going to have accelerated growth and essentially accelerated growth and adjusted EBITDA profitability, it means that they believe that their adjusted EBITDA profitability is going to be accelerated as well, which is good because ultimately that's just going to go back to that feedback loop that's going to have the new members that are unprofitable turn to become profitable. Okay. So there's that. So a lot of retail investors, unfortunately, they want money now. And this is going to be good for Wall Street because retail investors, I believe, are going to want to sell out because they're going to want money now. And that's going to be good for Wall Street because they can basically take these shares at discounted, right? So there's that, right? So with that, what could have been the adjusted net income this year, assuming if they would have had continuously grown without that, Part D crap, right? So that's a good question that I want to look at. And that is answered here. So 25 million. And Well, actually, no. I mean, it's better to look at it here. The supplemental slides. So to look at this, you would have to essentially look at the, if I could find it here, where the hell did it go? Yeah. Here's adjusted net income. You see how it went from $6 to $25? That's prognostic of what we might be able to see in the future. Okay. And I think that 322% increase is pretty huge, right? So with that, and given that that could be the case for the future, if they're guiding anywhere between 50 to 70 million on average, divided by 2 is the midpoint of $60 million of adjusted net income. If we were to look at what could be the future, I'm not saying this because next year or next year, I want to know in the next like 3-5 years, what could this be when this flywheel finally starts to grow the fruit? So I'm going to do that. If I start with 60 for like 60 million, and if I grow 322%, and if I grow 322%, what is going to be my end number? So let's see what the end number is going to be. So the end number is going to be $253 million. So that's, what I should see Clover in the next 3 to 5 years. That's the net income I should expect him to see. And the beautiful part is, if we were to take this and if we were to divide it by the outstanding shares and multiply that by 35, that's a $17 stock price. And if we were to go ahead, that's because that's 49 cents of earnings. And if we go ahead and basically take that and multiply it by, let's say 45, that's around $22.38. Right? So from that perspective, I think this, again, I can only speak for myself. It's just an educational platform. What I'm doing, again, just my own thoughts is I'm gonna buy more. I'm gonna buy more. I'm gonna buy as much as I can because I believe that Wall Street's gonna end up buying more as well. So the question is when are they going to become profitable? And this goes back to this one. So I find this very interesting. And I found some discrepancies, right? And I called upon these discrepancies. Actually, first, let's go ahead and generate a report. Let's go ahead, now that we had the price action from today, let's see what the Monte Carlos are basically telling us from our all stock trades terminal. So the 50-day forecast base is $2.24, okay, with the bullish of 393 and the fifth percentile being 128. So that's interesting to see there. Let's see kind of where we're bouncing off of here. Okay, so there's some support here on the daily chart. We can potentially head down here, 156. 285 seems to be the thing here. 180 was the buyback price for Vivek, and who knows? The stock is dangerous because Vivek can do an insider buy of $1 million, and this thing can change. This thing can change, right? The whole thing, and then, analyst price targets always fluctuate with the stock price. We're seeing a bounce here, so let's see if this, the lower end of 2 might hold. And we're going to see what institutions are doing in August 14. They're not going to be able to hide their hand. Now, assuming now the guidance for Clover, going back up here for Clover, they guided about how many billions of dollars they're going to make. So again, it's probably better to just do the supplemental slides. It seems that they're using AI a lot here. I'm looking for there. So this is their kind of what they're gauging.
1.800B, $1.875.
So if we take the average here, I'm going to just take the average and I'm going to divide by 2. Then I'm going to multiply by 1,000. So they're thinking about midpoint about $1.837 billion. So if I do this and multiply it by 5% to estimate cash flow, I get 91. I don't think cash flow is going to be 91 this year, but I'm just trying to do something that's interesting here. So
91.875.
if we go to the intrinsic value, type in CLOV and type in the free cash flow of 91, but this time I'm going to make the growth rate 0%. I'm going to basically make CLOV 0%. Okay. CLOV is 0%. I want to know what could be the bottom here. So by entering this and using our cloud-based system and hitting the classics here, you see a recession of 81. We're not going to be in a recession. A bear case of 126, a base case of 154, which is a technical support line, and the best case of 2, but that's them growing at 0%. So I think 2 will be a hard line, but it'll be interesting to see. Now, what is the trailing 12 months free cash flow? Well, the free cash flow this year for this quarter was 4.84 million. Now, again, I don't know what it's going to be in comparison to the next year's, but what I would like to do is a couple things, and this is going to be pretty interesting to do. So if we go here, and if we go, I'm going to just remove all this here. So I'm just going to clean this up. And I'm going to go to the fourth quarter, and I'm going to go to the cash flow statement here. This is going to be kind of a good thing to look at. Here's the cash flow statement. Okay, so check this out. Peter said, if we go all the way up top here, Peter said that we believe that we have now adequately normalized our claims inventory, and that our days in claims payable is within the expected range to go forward. Now, why is this important? Well, if we go ahead and go to the second quarter of 2025 and look at the cash flow statement, you can ultimately see here from the cash flow perspective, the unpaid claims here was actually negative. It took money away from us. And last year it was positive. And that had to do with the hack, which artificially increased the free cash flow. So if we were to look at this, and if we were to subtract this, you could see net loss. You can see it creep up higher than what it was last year. And I think it's going to be higher this year, but we'll see. If it's not, bullish. If they are the same net loss as last year's net loss was 43 million. If they somehow are the same net loss, then that's crazy. Then that's going to be very bullish. However, the stock terminal, if you look at analyst estimates, it's interesting because if you look at the net income for at least 2025, well, where's the average? They're thinking, yeah, here it is, the high. They're thinking negative 26. And I think this is going to end up changing because I don't think this is going to be the case. I think net income is going to be a lot lower. But we'll see. If it's not, bullish. But I think it's going to, I think it's going to be a lot lower. So, because you can already start seeing it here creep up, and that's because of the Part D. But you could see the unpaid claims it was negative, but it used to be positive. So if you were to look at free cash flow last year, operating cash flow, and subtract it from unpaid claims, there are about 16 million of free cash flow, 16 million of operations last year. So now let's go ahead and just compare it to this. I think what Peter's saying is they're going to be normalizing this. So I think this 16 million now is going to end up getting normalized, and it potentially could go to zero. Again, tough to say. I don't know, but that's kind of what they're basically banking on. Okay. So they were free cash flow positive this year. For this quarter. So now let's try to see if we can estimate. I'm going to assume they're going to lose $60 million this year. Okay, so I'm going to subtract. So that means I'm going to have to add. I'm going to have to subtract. So what? 60 million minus 43. I'm gonna have to subtract 17 million from my calculation. So I'm gonna do the 82.45,
82,450.
right? And I'm gonna subtract unpaid claims, which was 19.2 million,
19,296.
right? And then I'm gonna go ahead and I'm going to take this number
63,154.
and I'm gonna divide this by 1,000 to normalize it to millions.
63.154.
And I'm gonna subtract 17 million from them being more unprofitable to 60 million. If they are greater than 60 million, then it's going to be a lot lower. So that leaves us with a cash flow from operations at 46 million. Peter wasn't clear on if they're going to have strong cash flow from operations in Q2. He did say they will do it in Q1, but again, things have changed. So from that, I would say we kind of calculated from this. I would say let's divide everything by 2. That's about $23 million of cash flow from operations. And that's just taking a 50% haircut. Now, if you go here, and I want to look at CapEx. So let's hover it around, let's say $500,000 for each, about 2 million. So subtract 2 million. So that's about $20 million of free cash flow. So 20 million of free cash. So we take that now and divide that by 4. That's about 5.26 million. Again, that's tough. Again, I don't know that this might be the case, but again, this is why we have, the bare, base rather than just the best case. So when we do that, and if we type it now, 21 million of free cash flow, and then let's say we grow them at their high of 37%, we see a recession of 144, a bear of 310, a base of 432, and the best of 6.42. But analysts, they're like, well, hey, you know what? Maybe they might lower guidance. Who knows? So to be careful, we could take 37% and we can add 9% and divide by 2 for last year's growth, which is 23%. So if we take this and do 23%, this is kind of where I think analysts, I think the market's going to look at, right? So recession is 64 cents, right near that bottom. Bear is $1.25. Base is 168, and the best is 242. And again, this is just for the interim, I believe, from the educational perspective that we have from our intrinsic value software. I think this is for the interim because they're going to, this is kind of what I'm expecting in the interim. And of course, if they beat this free cash flow higher than 21, let's say, for example, they end up getting 30, then of course you're going to be able to see better, right? But for right now, this is kind of what I think right now, where we're going to end up basically being, at least for, this year, right? Unless they change. It's tough. I don't like doing it this way. I like to do more of a long range intrinsic value. This is more of a short term because we're, the growth rate's slow. This is like based off of reality. I would say, I think they're going to grow higher next year based off of Andrew Toy's words. But if we add, let's say 37% plus 9% plus another 37%, that brings the average down to 26 point
27.66.
right here, right? And then we take that times 7, we put that there. And then the goal is, when are they going to ultimately be break even? And that's kind of the magic here. When are they going to be break even? And this is going to be kind of what I'm waiting for. If we take 82,
82,450.
right, and I was hoping it would be this year, and if we subtract it from unpaid claims,
19,296.
and then we add 43 million, we get 106 million
106,154.
of cash flow from operations. And let's just basically take a 20% haircut. So we'll take 80% from it. So we could say 84.9 million. 84.9 million. Within the next 3 years, I'm expecting Clover to be in this range, right? Again, this is all educational, right? But I'm expecting to be anywhere between $3.36 to $13.58, right? And the thing is, that's why, I believe Clover is buying back their stock in the treasury, right? That's why they're buying back, because they're close. It's just the Part D got in the way, and that's because of the unfortunate Inflation Reduction Act. But they believe that this subsidy in 2026 is going to change. So again, there's a lot of data, lots of information that I'm just basically putting together right now. And people say your lives are too long, but look at everything we're talking about. I mean, go find someone that's willing to dig this deep. I mean, we're combining lots of data here. I mean, this is like no one goes this deep, right? So here's another things that were said. While not all market plan data is available, we have the reason to believe that this will be another strong membership growth season for us, potentially even stronger than this year. AKA, they believe that they could grow, membership growth even more. So, which is insane, right? So there's that. There's Peter. Involved in delivery of these outcomes are a number of healthcare ecosystem players, primary care physicians, risk-bearing ACOs, large hospitals, and of course, insurers, both regional and national. This is Andrew, I believe. So let's do a dividing line here. So this is basically telling you that they are talking about the national healthcare insurances. In particular, we're seeing a lot of residents with plans that need assistance, right? What plans? Healthcare plans, right? That need assistance with what? Star ratings and HEDIS quality scores, as well as managing costs within their PPO market. We've already seen subdomain analysis with Humana. It's just they cannot talk about it, right? And they're going to be talking about it here. I believe I put a quote, and that ultimately takes time. And I'm not expecting anything from revenue to materialize until 2029. And again, it may come sooner, but again, that's my expectation. As a reminder, while we aren't able to announce every customer, we have announced several large health system deals, and we're pleased with our progress with payer partners. Again, guys, money is transferred from the inpatient to the patient. And I would, for all those people out there that are impatient, thank you so much for giving me this deal. Thank you for helping me generate multi-generational wealth. Thank you for helping me with my family and my future. I appreciate you. God bless you. Thank you for your donation. Now get back to work in your W-2 so you can give us more. We thank you, and we might send you a postcard if you guys, to thank you. So we thank you for your contribution to the top 1%. We love you for what you do. Okay, now our MA plan also recently announced a pilot to use the counterpart. This is for the independent pharmacies. This will be interesting given Part D. Okay, and that'll be interesting to follow. Another thing that I looked at, this is all from the earnings. I believe we are well on our way to showing that Counterpart Assistant is capable of powering Medicare Advantage. That is incredible. What does that basically mean? Not just in our own plan, but in any managed care setting nationwide, and that it's ready for prime time scale. That is huge. That is very, very bullish. Okay. Now, next statement. Simultaneously, we are setting the stage for even a more impactful 2026, which we believe will cement our position as a leader in Medicare Advantage. So 2026 is most likely going to be, it's going to get to a point where unquestionably so Clover is going to be looked at as one of the leaders in MA. And again, stuff like this takes time. Money's transferred from the inpatient to the patient. We already copied this. This is from here. Since last quarter, the MA book has continued to increase membership, and we are now projecting ending 2025 with even more members. This is not just growth for growth's sake. We are making a real difference by bringing earlier care management via Clover assisted technology to more MA seniors. Now they talk about Part D here. However, we are seeing some of the elevated cost trends within our MA books that others in the industries have identified. That said, we are generally satisfied with the underlying trends we are observing in our portfolio. I would note that we are keeping a particular close watch on the impact of Part D IRA change this year, given that this is the first year of the new program. There is less of a historic baseline to trend against, and we anticipate more variability in our modeling of performance. As such, we are diligently monitoring this to see how it plays out through the remainder of the year. Put it another way, while I think we are appropriately focused on delivering our care management model, we are also recognize that, and here's the thing, transcripts are saying Part B. This is incorrect. They're doing this on purpose, just like they also did it for Andrew and Peter. Here's it for Andrew. And it's interesting. They also basically pumped out a fake article stating that Clover is revising their revenue down. That is incorrect. So it says here, remains a big known unknown for the second half of the year, which makes sense because Alignment Healthcare said the same thing. Humana said the same thing, and United Healthcare said the same thing, right? So this is also consistent with recently published Part D, because obviously they're talking about Part D. That's why it says Part D, direct subsidy rate, which is marginally higher for 2026 than for 2025, signaling higher costs than expected by the industry. The good news is that this also gives us a reason to believe that Part D pressures in 2025 might be alleviated in 2026. So that's good to hear, which means that that'll basically get us back online. Okay. So then Peter goes ahead and adds, yes, I'll answer the question. So the cohort, and I want to make sure this message is clear and lands, right? The cohort in our unique model, tech first model, are performing as expected in line. So for Part D and supplements, we don't see a specific split between the new member, returning member. So the Medicare, the medical side of things is doing good. What else? And then he adds about 2026 direct subsidy. And then this is my favorite part. Yes, for sure. I think that obviously we are noting that cost trends, like within managed care in general and even Medicare Advantage, there's been a lot of motion this year by the national players. The way that we see it is that the products that they're most pulling back, while all of them pretty much are pulling back to some extent, where they're pulling back count and where they're pulling back is generally within the PPO market, which is good because that's what Clover's doing. They struggle to deploy their existing managed care capabilities. I think that's an area where we are very strong based upon our technology from the counterpart side. So we feel good in our core markets. We feel that people are pulling back. They're quite likely to pull back within those same markets. He's pretty much saying they're going to pull back in their same markets because those are challenging for the same reason they're good for us. So he's pretty much saying, these are challenging for them, but they're good for us because of the Clover Assistant. So that's why within our commentary, we said that while we don't have all the data yet, we feel like we're likely to be very well placed into the growth season. Okay. So that's pretty much it, guys. That's what I have. It was a quarter that gave us a Part D uppercut, but it looks like the industry is feeling this. And it's not due in part with the counterpart. There's been a lot of speculation saying, oh, Humana or whatever, they're going to end up canceling this. Humana understands that Part D is crap and next year is going to be better. Okay. United understands that Part D is crap and it's going to be better next year. Alignment understands that Part D is crap right now. It's new. There's not a lot of data. So there's some discrepancies. And right now, Clover is accelerating its growth. So you have a lot of right now things that they're juggling, right? And the beautiful part is we've seen from our data that the Clover Assistant is able to decrease medical costs by 1,000 basis points in 1 year, even to 1,400 basis points, because last year's people are being decreased by 700 basis points this year, and last year's people are going to be decreased by 800 basis points next year. And this year's people are going to be decreased by 700 basis points next year. So with that, you're going to get essentially older members coming in unprofitable and new members coming, newer members unprofitable and returning members profitable. And at the end of the day, operating margins, year one is a loss. The returning members, profitable. Year one, loss. Others, profitable. So I think we're in line. And I think personally, a lot of retail investors were very excited with SaaS. They're like, SaaS. But SaaS takes time. A lot of those people that bought in at 4 most likely are selling out now, right? They're basically getting washed away. They're down. They're upset. Let them go. Let them donate their shares to essentially institutions. Those folks, let the lions hunt, let the gazelles die. Those thank the gazelles, take their blood and put them on your head and honor them, because in the end of the day, in 5 years from now, I believe that Clover Health is going to be a different company than what it is today. And it's going to be very powerful. It's going to be amazing. I appreciate you all, and have a blessed night, and God bless you all.